Owning a home is easier than you think. On this webinar, I'm going to show you how home ownership can become a reality, not just a dream. Hi, my name is Amanda Roberts. I've been a real estate agent for over 20 years, a broker for 10 years, and a real estate coach to over 700 agents nationwide. I'm going to take you down a path to teach you exactly everything you need to know to buy a home and to make that dream a reality. But first, let me tell you a little bit about my journey. So when I was in my early 20s, my husband and I contacted a real estate agent to see if we could buy a home. The first thing that agent asked me was, how much money do you have to put down? You're going to need at least $5,000. So at that point, we did not have $5,000 to put down, and my dreams were dashed. Then I spoke with an agent a few months later who said, you don't need $5,000 to buy a home. There's down payment assistance programs. And she took us under her wing and went out and showed us property. That agent was the one that made it happen for us, and we bought our first property, zero down. So from that moment forward, I made it my life's mission to become an agent and help other people buy a home just like she had helped me. And for the last 20 years, I've been helping first-time home buyers and move-up buyers buy that dream home. On this webinar, we will discuss what it takes to qualify, income and credit requirements, how to find the right real estate agent, knowing when you found the right house, submitting an offer, what happens after the offer is accepted, and the total cost to expect when buying a home. First steps. Speaking with the loan officer should be your first step. He or she will go over the income and job requirements and your credit requirements to buy a home. They're going to pull your credit and determine if your score meets their guidelines. The next step is for them to look at your individual debts and creditors. Most lenders are looking for a minimum 620 credit score. There are some that will go as low as a 580. But with your on-time payments in the last 12 months, you should be good to go. Late payments, judgments, collections, they may cause your loan to be denied, but in some cases, they can be excused. Debt ratios. So there's several different loan programs, and the debt ratios vary from one to the other. A good rule of thumb is 1/3 of your income to be allocated for debts. This includes your new mortgage, taxes on the home, insurance for your home, and any HOA fees should there be any. Additionally, this will include any other debts such as credit cards, car loans, installment loans, and student loans that are not in deferment. So here's a DTI example. This is going to be based off of $60,000 per year in the household. So that could be one individual's income. It could be one family member makes $40,000 a year, the other one makes $20,000, both make $30,000, but this is just a household income of $60,000 per year. So the ideal debt ratio is going to be 33%. So based off a salary of $60,000 per year, the ideal monthly outgo should be no more than about $1,650 per month. Don't get hung up 100% on that number. I'll go into this a little bit in more detail, but that is going to include your mortgage. So below is an example of a debt ratio with and without credit cards and a car loan. So we're going to go off of this first one here. We're just basing this off a mortgage of $1,200 per month, taxes of $100 per month, insurance of $75 per month. And so we're going to use that as our base. So here we have in the first scenario, zero credit card debt, but there is a car loan of $350 per month. So that's a total of $1,725, and that would make that a debt ratio of 35%. In the second scenario, it's the same situation with the mortgage, taxes, and insurance. However, in this scenario, there's $75 a month in monthly outgo on credit cards and a $350 a month car loan. So this will give a total of $1,600 per month in monthly outgo. So that's going to be about a 36% debt ratio. Now, in the third example, it's just monthly credit card payments and no car loans. So that monthly outgo is $1,450 a month. We have a nice low debt ratio of 29%. In the last scenario, we have zero credit cards and zero car loans with a monthly outgo of $1,375, which is the total of the mortgage, taxes, and insurance. So in this scenario, that's a debt ratio of 28%. The 33% debt ratio rule does not apply in every loan program or situation. There are exceptions to the rule. There are programs that will allow a debt ratio as high as 50%. So you're always going to want to ask your loan officer about the different programs that you may qualify for. So finding the right real estate agent. How do you decide? Because there's tons of realtors out there, tons of licensed agents. So while there's tons of agents to choose from, not all agents specialize in helping buyers. Some agents have more experience helping sellers and may not understand all the negotiation tactics needed to get an offer accepted for a buyer. Now, some agents are brand new and have little experience with writing offers and negotiation. Other agents work part-time, they have another full-time job, and they're not as available to show property as others. Additionally, there are some agents with so much experience that they are in high demand and they find it hard to squeeze in a new buyer. There are just certain questions that you're going to need to ask an agent when you're considering to have them represent you on your home purchase. Now, how real estate agents get paid. It's important for you to understand this, especially when it comes to negotiations. A lot of buyers don't realize that they don't have to pay the agent, that the seller actually pays the agent, but there are some exceptions, so I will go over that with you. So real estate agents typically make 2 to 3% per transaction, sometimes less, but that's the average. So if you're buying a $300,000 home, they stand to make anywhere from $6,000 to $9,000 on the sale. However, most agents must pay their broker 20 to 30% of that amount. So it will cost them approximately $1,200 to $2,700 just to handle the transaction, and in some cases even more. Additionally, agents must pay MLS fees, board dues, E&O insurance, desk fees, gas expense, marketing expenses, key access fees, etc. An agent may end up only making about 1% of the purchase price by the time they pay all the expenses to be an agent. So a standard transaction can take anywhere from 20 to 40 hours depending on the difficulty level of the file. So a busier agent may have an assistant that helps them from time to time. This will allow them to better serve you. Again, that's a good question to ask. Do you have an assistant? Now, just because they may not have an assistant doesn't mean they're not a good agent, but this will help you understand the level of agent you're working with. A good agent will be able to devote at least 3 to 4 hours per week to showing you homes, possibly more, but keep in mind an experienced agent is going to be juggling other clients as well. So where does the money come from? So typically speaking, the seller pays the listing agent's brokerage 6% of the total purchase price. Now the listing brokerage shares that commission with the buyer's agent for bringing the buyer. It's typically split in half between the two brokerages. However, since we are in a seller's market, there are situations where the listing agent's broker has decided not to share the commission with the buyer's broker. So in this event, the buyer would need to compensate the buyer's agent. This doesn't happen often, and should this situation arise, the buyer would be able to choose another home if they did not want to pay the commission. Of course, all of this would be in writing from the beginning, and there should be no surprises if you're working with a good agent. Now, here's the timeline of what to expect as a buyer. It can take as little as 30 days to go through the process of finding and buying a home, but most transactions take 60 to 90 days from start to finish, some even longer. So factors that can cause a transaction to take longer can be inability to find the right home, inspection and or appraisal delays, credit issues, sellers not being able to close until a future date, new construction completion, availability of supplies. You get the idea. In the beginning, you're going to want to get that pre-approval letter from the loan officer. So you're going to contact them. They're going to pull your credit. You're going to get the letter. We pretty much went over that. Next, you're going to choose the agent, and then they're going to send you a list of homes that meet your criteria. Then they're going to schedule those homes for you to view. Then you're going to go out and look at those homes. Now, once you've seen one or more homes and you find one that you like, the agent is going to write an offer and submit that to the listing agent, and then they are going to show it to the seller. Now, if the seller likes your offer, and keep in mind there may be multiple offers coming in on a property, they are either A, going to accept your offer, or B, they're going to counter. So once both parties are agreed to the terms, you will sign it and it'll be bound. Your offer is accepted. Agents are going to order an inspection That's going to be on the agent side. The appraisal is going to be ordered by the mortgage company. Now, appraisals are not optional. Inspections are. I will go into a little bit more detail about inspections later, but just so you know, this is the next phase. Now, afterwards, you're going to go to underwriting. There's going to be a title search. The underwriter typically does not look at your file until you've been through appraisal stage because they want to make sure that the property in question is even worth what the seller's asking before they go through all that trouble to look at all the paperwork. So typically you do not go into underwriting until the appraisal is completed, and this is typically around the same time that the title search is being done. Then your final walkthrough and closing, that's when everything's gone through underwriting, you have a clear to close, you're moving on to the closing department, and at that time the realtor is going to schedule a walkthrough, and then your mortgage company is going to let you know on a closing date. Hopefully it lines up with what the contract says. If for some reason it goes over, your agent can always get you an extension. Finding the right home. Finding the right home may be harder now than ever before, but a good agent will ask you lots of questions about the type of home you're looking for and the area you want to live in. They will need to know what city, square footage, purchase amount, number of bedrooms and baths, if a large yard or garage is a must. Additionally, they may need to know maximum age of home, conditions that are acceptable like a brand new home or a fixer-upper. The more information you can give the agent, the easier it will be for them to find you the perfect home. Your perfect home wish list. While you may have an extensive wish list when it comes to your desired home, budget can sometimes put a damper on things. So if you're working within a certain budget, you may have to live without a few things on your wish list. So no agent wants to tell a buyer this, yet if you go into the transaction with proper expectations, it will go quicker and easier for you. Number your wish list in order of importance. So if 3 bedrooms is a must, then don't bend. If a garage is a want and not a need, then be flexible. Keep in mind you can always add on later or convert space such as dens, dining rooms, basements, and unfinished walk-in attics into more desirable uses. Be creative and flexible and you will find the right home. Submitting an offer. When it comes to submitting an offer, you need to keep a few things in mind. What is the maximum amount you are willing to pay for this house? How much are you pre-qualified for with the mortgage company? How much out-of-pocket reserves or cash are you willing to bring to the closing to make this deal go through? What items are you willing to negotiate or forego? Most likely you will be competing against other buyers for the property and you will need to put your best foot forward. Some properties will receive 20+ offers. Some of the offers will be thousands over list price. A good agent will guide you in writing the best offer for you, the property, and the seller. So once your offer is accepted, additional documents may need to be signed. A good agent will explain everything to you and answer any questions you may have. At any time, if you feel that your agent has not properly represented you, you can reach out to their broker and raise your concerns. Most agents want to avoid this, so they will go above and beyond to make sure you are happy with the transaction. An inspection and appraisal will be ordered and is considered an out-of-pocket expense for buyers. Additionally, you will need to provide earnest or trust money, also known as good faith money, to secure the transaction. That typically is held in escrow by the title company or the listing brokerage. Out-of-pocket expenses to a buyer. So below are some, but not all, potential upfront out-of-pocket expenses you may incur as a buyer prior to buying a home. So an inspector, that can cost you anywhere from $350 to $600, and that's going to need to be paid prior to the inspection. That comes out of the buyer's pocket. I highly recommend having an inspection. This can be waived. Appraisal. So that can be anywhere from $400 to $600 paid before appraisal or at closing, depending on your loan program. This cannot be waived unless you're paying cash. Trust money. Typically speaking, you're looking at $500 or more. Depending on the property, you may want to put down at least $1,000. However, this can be negotiated. I've seen it go as low as $200. This will be credited on your closing documents. So ask your realtor or loan officer what the rate is in your area for these expenses and if they are required upfront. Zero down programs. There are many options for first-time home buyer to buy a home for zero down. The two most common are VA and RDA. So VA loans are for military veterans who are honorably discharged or currently serving in the U.S. military. RDA loans are for any property that is considered rural in America. Even some suburbs qualify. Both loan types offer 100% financing, so speak to your loan officer to see if you qualify. So what if you're not military, and what if you don't want to live out in the country? FHA would be your next best option. It only requires 3.5% down of the purchase price. And in most cases, there are funds in your local area that assist with the 3.5% down. They are called down payment assistance programs. So these funds are provided several different ways. Your loan officer will know what is available in your area. So no matter the loan program that you go with, you're going to have closing costs. Closing costs are fees incurred to close on the home. It typically includes local taxes, title search fees, processing fees, loan origination fees, transfer of the deed, per diem interest, prorated taxes and insurance, mortgage fees, etc. So an average rule of thumb is to expect 3 to 4% of the purchase price. On some loans, though, upfront PMI or MIP is included in the closing costs and can add another 1 to 3% of the purchase price. Also, depending on what time of year you close, that can affect your closing cost as well. So your loan officer should give you a breakdown of the fees at the beginning of the transaction, and this is just an estimate of fees. So as the transaction progresses, the fees will be more concrete and they can update you along the way. PMI and MIP, also known as private mortgage insurance. Mortgage insurance is a premium you pay to a third-party insurance company that insures the amount of the loan that you borrow over 80% of the home's value. This guarantees the lender, should you default on the mortgage, they will receive any amount due over 80% of the value. It's pretty much an equity insurance policy for the lender that you pay as the buyer. The only way to avoid PMI or MIP is to put 20% down. Benefits of home ownership. So you got the pride of owning a home, you get to stop paying rent, you can grow a garden, you can have pets, you can build equity, you get to customize the home to you. A lot of rentals won't even let you paint. No increase in monthly payment, an asset that you can will to your family. You get borrowing power. So you're going to be able to do a home equity line of credit with your equity, and you get to build memories with your loved ones. So here's some statistics on owning a home. So the median age of a first-time home buyer was 34 years old in 2019, sourced from Experian. And those who bought their first home between ages 25 and 34 have the greatest housing wealth by their 60s, source urban.org. The average home equity gained between the third quarter of 2020 and the third quarter of 2021 is about $57,000. That came from CoreLogic. We're talking 1 year, guys. 1 year, and the average home equity gained was $57,000. The home ownership rate in the U.S. amounted to 65.5% in 2021. That came from Statista.com. First-time home buyers make up 33% of all home buyers. 1 out of 3. That came from PolicyAdvice.net. In 2019, homeowners in the U.S. had a median net worth of $255,000, while renters had a net worth of just $6,300. That came from CNBC.com. So for households in the middle of the income distribution, housing wealth represented between 50 and 65% of their total assets. blog.firstam.com. So as you can see, there's lots of benefits to owning a home, some that you probably haven't even thought about. Equity is a great wealth builder. With an average appreciation of 3% per year, the average home in America increases in value approximately $10,000 per year. That is actually a very low number. This is based off a purchase price of $300,000. Every time you make a payment, your principal balance goes down. So the gap between what you owe and what your home is worth grows larger each month. This gap is called equity. It's like having a piggy bank that grows in value every time you make a payment. Imagine how large your piggy bank balance could be in 10 years. This is a great source for building wealth. Lots of people cash out their equity and buy another home or even pay cash. And once you have enough equity, you can even borrow against it. This can help you leverage your equity to start a business or pay for your children's college. The possibilities are endless. Now you are informed on the basics of buying a home and the benefits. It's time to take those next steps. A good agent can recommend a reputable loan officer who will handle your file like it should be. They can help you find the right house and negotiate the best offer. They can guide you through the entire home buying process. Like stated before, not all agents have equal abilities to help you through the process effectively. We know this to be true because we have been agents for over 20 years. Additionally, we have coached agents nationwide for years. We know these agents are the cream of the crop and can get the job done. Each one has attended Real Estate University and is a class above the rest. This is a program that we offer that only takes 30 agents per year. That's it. We only take 30 agents per year. So if you're watching this webinar, then you are in an area where one of our elite agents cover. The next step is for you to schedule a time to speak with our agent. Please click the link to the calendar and choose a day and time that best suits you. You will receive a phone call at that time from the agent who will then explain how the process works. He or she will be able to help you from there. Thank you for watching. We look forward to helping you buy a home.